Hey, all you farmer and ranchers! March 1st will be here before you know it. Let's go over some tax tips before you get that return filed. How about we start with an easy one? What income counts and how should you be reporting it? Here's a list of farming income to report on Form Schedule F.
Wait, what about cash rent?
If you cash rent your farmland to another person and do not materially participate, then that income should be reported on a Schedule E. This matters because you do not pay self-employment tax on a Schedule E. You pay self-employment tax on a Schedule F. Same goes if you crop share and do not materially participate. Then this income will be reported on a Form 4835 in the year that you convert the shares to money. The Form 4835 net income or loss will carry over to the Schedule E, which again isn't included in self-employment income. Keeping good records of your livestock can be really beneficial come tax time. The classes of livestock are reported differently to the IRS and can have some tax savings if you follow the tax code. You need to separate and categorize your livestock transactions as livestock purchased for resale, livestock raised, livestock purchased to be held, livestock raised to be held. The sale of raised livestock not held or livestock purchased for resale is reported on the Form Schedule F and subject to self-employment tax. Livestock held for draft, breeding, sport, or dairy purchases, bought or raised, is reported on the Form 4797, which is taxed as capital gains income, and that is the lowest category of tax that you can pay, so you want this. The third tax tip is gifting grain. Gifting grain allows farmers to exclude grain income from being taxed while still being able to deduct the expenses. You can either gift grain to a charitable organization or your children. To make the grain gift, the farmer delivers the grain to either the co-op or the elevator and puts it in either the charitable organization's name or their children's name. Then the charity or their children can determine when to sell the grain. And as long as your children are not materially participating in farming, then the grain income is treated as unearned income, which is taxed as capital gain. And you already know that's the tax that you want. Most of you farmers probably already know this tip, but if you can't take your loss in the current year because it's too big of a loss, then you can use that loss in future tax years. Saving this loss for future tax years will reduce that year's taxable income, which will save you taxes in the future. Prepaying expenses is really beneficial if you use the cash basis method of accounting. You can deduct your prepaid farm expenses in the year that you pay for them to even out your income and expenses. But one thing to keep in mind, if you do deduct your prepaid expenses in the year that you pay for them and not the year that you use them, you are limited to 50% of the other deductible farm expenses for the year. Another tip that you're also probably familiar with is the 179 deduction and bonus depreciation. But let's go over it just in case. The Section 179 deduction allows you to deduct qualified property during the year it's placed in service rather than depreciating over several years. And bonus depreciation allows you to take 100% of the qualified property. And for tip number 7, sorry farm kiddos, you don't get to pull the child labor laws on your farming parents. There is no minimum age for children to work on small farms or family farms, just as long as they don't miss school. If you hire a child as an employee, you can deduct reasonable wages for farm work. If your child is under the age of 18, then you do not have to pay Social Security and Medicare taxes on the wages paid. But the month that the dependent child turns 18, their wages are subject to Social Security and Medicare taxes. Just because you're a self-employed farmer doesn't mean that you're excluded from retirement plans. There is a simplified employee pension plan that allows self-employed individuals to contribute to a traditional IRA. SEPs also allow self-employed individuals to contribute 25% of their net earnings, up to $58,000 for the year. On top of that, the contributions made to a SEP IRA is a deductible expense. So you get to use your SEP IRA contributions as a farm deduction for the current tax year. If you use a portion of your home to conduct farming business, then you can expense some of your otherwise non-deductible expenses through the home office deduction. And last but not least, we have fuel credits. Most farmers are familiar with dyed diesel fuel, which is dyed for non-taxable use, meaning you must use it only on a farm or for farming purposes. When you use undyed diesel fuel for farming or other qualifying purposes, then you can recover the excise tax paid on the undyed diesel by claiming a credit or filing for a refund. Being educated on the IRS Farmer's Tax Guide can help your farm operation a lot with tax savings. We appreciate our farmers and don't want them to miss out on any tax savings.